fundsupermart.com.
Hi, Stephen. What had contributed to the strong market performance in 2013?
I think investors felt that Europe was recovering. They saw some economic data troughing, and they also saw sovereign risks declining. In addition, the U.S. Market started to rally, and so investors started to price in a full economic recovery. As we know, markets are forward-looking, and they will move in anticipation of future results, and the European market has done that. So we've seen valuations rise in anticipation of earnings being delivered in the future.
How would you describe the current Eurozone political and economic momentum?
It's as you would expect in an economic recovery, or the beginning of an economic recovery. In fact, the data is mixed, but that's what you would expect. The ECB recently lowered their growth rate target, the GDP growth for the region, from 1.5% to 1%, and they lowered their inflation target from 1% to 0.7%. But despite that, if you look at some of the underlying data, it's actually quite positive. Purchasing manager indices for manufacturing and services are actually up, though we see strength in UK and Europe, or UK and Germany, but some weakness in France. We see consumer confidence coming back. We also see domestic demand, leading indicators for domestic demand, also rising. So it's mixed, but we're positive that on a 2 to 3 year view, that Europe will fully recover.
How will the recent ECB's additional monetary stimulus impact European equities in 2014 going into 2015?
I think it's positive for equities in that the ECB is signaling that they stand ready to fight deflation. If you look at the 3 parts of their action, taking deposit rates down, providing loans, low-cost loans for banks to then loan to corporates, and then also buying back some securities, packages of loans to non-commercial companies or non-financial companies. I think if you look at the individual aspects, they won't affect the outlook that much. But the value of the ECB moving when they did is to signal to the market that they stand ready to fight deflation. Their inflation number came back from 1 to 0.7, and so there's been a fear that Europe will fall into some deflationary malaise as Japan did. But they wanted to, I believe, reassure the markets that they're ready to fight deflation, and if so, embark on a quantitative easing program.
What are some short-term roadblocks when investing into European equity?
I think on a 2 to 3 year view, investors would benefit from owning good companies at reasonable valuations. But in the next 6 to 12 months or so, there are some bumps in the road. Namely that the market rally that we spoke about at the beginning has largely come about from valuations increasing, whereas earnings have not been delivered, or earnings growth hasn't been delivered to the same extent. So the market's trading at, say, 17 times earnings for 10% earnings growth. The market's actually pricing in higher earnings growth and a full economic recovery. In addition to this, we need to see earnings being delivered. In addition to this, geopolitically, there's some conflict in Ukraine and emerging conflict in Iraq, which can also lead to energy prices rising, which would perhaps provide some stalling to the economy. And then finally, there's going to be an asset quality review of banks' balance sheets upcoming, and also a stress test later this fall. And the results of that there'll be some surprises probably with banks' financial health. So we'll see some banks need to raise capital, others will be fine, and that will cause some uncertainty in the market. So all of these will provide some opportunity to buy into the longer-term recovery story, but it will be choppy in the short term.
Thank you.